Welcome to TechCheck Weekly. We bring you up to speed on the biggest story in tech and investing. This week, we're looking at Wall Street's love-hate relationship with Meta, the company formerly known as Facebook. Today, could Mark Zuckerberg be at another and perhaps his biggest inflection point? What investor Brad Gerstner calls a refounding moment akin to Steve Jobs coming back to Apple. Put another way, is Zuckerberg on the right path to unlock the mojo needed to win in the age of artificial intelligence? Let's take a look. Last year, Wall Street hated Meta so much, it lost 2/3 of its value. This year, it's nearly made all of that back. But really, the fickle relationship goes back even further, all the way back to its IPO. Facebook spent the first year of its life as a public company trying to convince investors that it could keep up with the shift to mobile. Later, it lost its cool factor. But ads were ultimately extremely profitable, and it turned Facebook into a cash printing machine until Apple came along with its privacy changes that upended the entire business model. So Zuckerberg turned to the Metaverse.
We basically believe that that the Metaverse is going to be the successor to the mobile internet. You're going to be able to access the Metaverse from all different devices. Within the Metaverse, you're going to be able to hang out, play games with friends, work, create, and more.
And investors, well, they hated it.
I don't think most investors believe in this investment, maybe they believe in it, but they believe it's uninvestable over the course of the next 5+ years because this is 10 years out.
And if we're being honest here, more than they hated the hype around the Metaverse, what they really hated was its price tag. At one point, the company vowed to spend $10 billion a year on Metaverse investments. One article asked, is Meta's $70 billion bet on the Metaverse shaping up as the biggest money pit ever in tech? Another, the Metaverse is a masterclass in sunk cost fallacy. But Zuckerberg was determined, and besides, there's nothing that anyone could do. Zuckerberg owns the majority of voting rights to the company, so he very much has control. Investors couldn't kick him out, even if they wanted to. But then, this year, 2023, something happened.
I want to discuss my management theme for 2023, which is the year of efficiency. My main focus is on increasing the efficiency of how we execute our top priorities. It really just makes sense to really focus on the efficiency. This was the beginning of our focus on efficiency, and really crank on efficiency. You're operating more efficiently. Improving our monetization efficiency. One is efficiency and work more efficient efficiency. The efficiency and efficiency that will just make us more efficient.
Zuckerberg had traded Metaverse mentions for efficiency and Silicon Valley employee perks for cold, hard layoffs.
Fascinating to see the change that Zuckerberg has sort of taken the company in. The response, of course, in the stock market, Mike, has been quite significant. Really, since you see those early November lows, and then moving off of there, right with that first announcement of the headcount reduction at that time. But again, they're going to go well beyond what would have been what the ask was from some of the shareholders.
Meta announced layoffs last year, 13% of the company, and didn't stop there. Reporting suggests another round of layoffs targeting middle management is coming any day now.
We're working on flattening our org structure and removing some layers of middle management to make decisions faster, as well as deploying AI tools to help our engineers be more productive. As part of this, we're going to be more proactive about cutting projects that aren't performing or may no longer be as crucial. But my main focus is on increasing the efficiency of how we execute our top priorities.
Layoffs, layoffs, and more layoffs. Noted tech investor Brad Gerstner told CNBC something really interesting this week that we wanted to take a closer look at. He's arguing that Meta's decision to get fit is a game changer. Here's the full quote. Meta's decision to get fit, it's not just a cost story. This is a refounding moment for Zuckerberg, akin to Steve Jobs coming back to Apple and realizing the complex management blob had undermined talent, velocity, and innovation. Just as Apple's cuts, simplification, preceded the iPod and iPhone, Meta is on a mission to get simpler and faster because it will unlock the mojo needed to win in the age of AI, end quote. When Steve Jobs returned to Apple in the late 90s, he drastically cut the number of products Apple produced and he laid off a few thousand employees. He would introduce the iPod just a few years later. Focus, that was his silver bullet. So can Zuckerberg pull off the Jobs playbook? Can he engineer another giant shift in his own business model?
When you compress the layers in an organization, you get to more productivity. And that's really what this is about. The next 5 to 10 years, they're one of the best positioned companies to capitalize on this move to AI.
The evidence is building. This year, Meta became more loved than Google on Wall Street. Its price to earnings multiple, that's a valuation metric, it surpassed Alphabet's for the first time in years. It's getting back to its core, hitting 2 billion daily active users on the Big Blue app. Its new AI-based advertising tool, Advantage Plus, it's boosting ad campaigns for its customers. And TikTok, or lack of it, could be the cherry on top. If U.S. lawmakers succeed in banning the Chinese-based competitor, that could clear the way for Instagram Reels to really take off. So Zuckerberg is cutting costs and he's focusing on the core. But what about that other focus? Because there's still the metaverse overhang and billions of dollars still earmarked for the moonshot. Does Zuckerberg continue to try and turn the ship, or does he abandon it altogether? One sign that things might not be going so well for the Oculus and Meta's metaverse ambitions? Well, the company recently announced it is slashing the price of the Oculus Quest 2 and its high-end Quest Pro headsets. Remember, these were just launched in October, so what does it signal about demand if prices are already going down? The Quest 2 is going from $500 to $430, while the price of the higher-end Meta Quest Pro, that will be slashed to $1,000 from $1,500. Remember, this is the unit of Meta that is bleeding money, Reality Labs, and it generated revenue of $2 billion in 2021, which includes the sales of headsets. On that revenue, it lost a total of $13.7 billion, and that is a completely staggering number, part of why Wall Street analysts and investors fell out of love with Zuckerberg in 2022. Now, in comparison to the high-cost, money-losing metaverse business, could AI be an area of investment and a profit driver for Meta? We've already talked about Advantage Plus, these new AI tools that are helping advertisers target ads and make more money. Meta recently announced that it had trained and released a new large language model to researchers called Llama. Will that actually drive business? The street seems to think so. One analyst from Oppenheimer this week raised estimates for the company. Here's a quote from his report. "We are increasing our target to $235, it was $220, on higher advertising estimates as AI investments are beginning to drive improved targeting." Another example, Mark Mahaney from Evercore ISI. He's a longtime Facebook bull, but this week he made it his #1 pick on the internet industry. Here's a quote from him. Meta is clearly moving to reduce a cost structure that arguably became bloated post-COVID. Layoffs, check. He says, "Our checks suggest improved ad attribution is helping to recover more ad dollars. Business improving, check." And he continues, quote, "The business model is still high margin and high free cash flow generating. And we're still talking 14 times GAAP PE with 50% upside to our $275 price target." One noted media analyst on Twitter described it this way. "I've been covering the internet sector for a while, and these multiples are pretty wild." Meta and Alphabet both trading around 14 to 15 times next year's earnings number is historically cheap. And that is really the key for Meta and Mark Zuckerberg right now. He is clearly cutting costs. The valuation is not stretched. We are 2 months into the year of efficiency, but can the company really use this moment to refocus? And how much will the metaverse investments drag on the entire organization? There's one more angle to consider. Meta has historically bought its way into new growth markets. It bought Instagram, it bought WhatsApp, it bought Oculus. Now, with the government so focused on antitrust and anti-competitive deal-making, Zuckerberg is much less likely to be able to make a game-changing, industry-defining acquisition. Can Zuckerberg build something himself?